The global hegemony of US dollar: structure, power, fragility, and the future of monetary dominance. Introduction: Currency as infrastructure of power. The dominance of the US dollar is not merely a monetary phenomenon. It is a structural architecture of global power embedded with trade, finance, energy markets, military alliances, and legal institutions. Since the mid-20th century, the dollar has functioned as the central node of global economic coordination. International contracts, commodity pricing, cross-border debt issuance, reserve management, and financial risk hedging have been all deeply integrated into a dollar-centric system. The global economy doesn't merely use the dollar, it operates through it. The persistence of dollar hegemony is not accidental, it is the outcome of institutional design, geopolitical positioning, network effects, and strategic credibility. The dollar functions simultaneously as a medium of exchange, a unit of account, a store of value, and an instrument of geopolitical leverage. No other currency currently provides the same combination of liquidity, trust, convertibility, scale, and enforcement infrastructure. The significance of dollar denominance extends beyond foreign exchange markets. It shapes interest rates, global capital flows, geopolitical alliances, sovereign debt sustainability, trade imbalances, and economic development pathways. Understanding the structure of dollar hegemony is therefore equivalent of understanding the architecture of modern global order. Historical foundation: Bretton Woods and institutional lock-in. The contemporary international monetary system traces its origin to the Bretton Woods Agreement of 1944. Following the devastation of World War II, policymakers sought to construct a stable financial system capable of preventing the competitive devaluations and protectionist spirals that had contributed to the Great Depression. Under Bretton Woods, currencies were pegged to the US dollar, while the dollar itself was convertible into gold at a fixed rate of $35 per ounce. This arrangement placed the United States at the center of global monetary coordination. Countries accumulated reserve dollars to stabilize exchange rate, finance trade benefits, and manage balance of payments pressure. The United States emerged from the World War II with unmatched industrial capacity, technological capability, and gold reserves. Its economy accounted for a significant share of global output. Trust in US institutions were reinforced by political stability, relatively market governance, and deep financial markets. When President Richard Nixon suspended good convertibility in 1971, the formal Bretton Woods system ended. However, the structural advantages of the dollar persisted. Global trade contracts, debt markets, and financial infrastructure had already been denominated in dollars. Path dependence ensured continuity. Dollar hegemony therefore survived the collapse of gold backing because confidence had shifted from metal to institutions. Network effects: why dominance becomes self-reinforcing. Currency dominance exhibits strong network effects. The value of a currency increases as more actors use it. When exporters invoice in dollars, importers demand dollars. When borrowers issue dollar-denominated debt, investors accumulate dollar assets. When commodities are priced in dollars, hedging instruments are built around dollar contracts. This creates positive feedback loops. Liquidity attracts liquidity. Market depth reduces transaction cost. Lower transaction cost increases adoption. Once a currency becomes deeply embedded in payment systems, clearing mechanisms, derivative markets, and international contract switching become costly. Firms would need to rewrite contracts, redesign hedging strategies, and adjust accounting frameworks. These switching costs create inertia. Dollar dominance persists not because alternatives are unavailable, but because replacing an entire financial ecosystem is expensive. Institutional foundations: credibility, rule of law, and market depth. A reserve currency requires more than economic size, it requires institutional reliability. Investors demand practicable legal enforcement, independent monetary policy, credible fiscal management, and transparent financial reporting. US Treasury securities represent the largest and most liquid government bond market in the world. The depth of the Treasury market allows central bank, pension funds, sovereign wealth funds, and institutional investors to deploy capital at scale without significantly affecting prices. Liquidity reduces risks. The Federal Reserve operational independence reinforces credibility. Market participants believe that US monetary policy prioritizes price stability and employment within a predictable framework. Legal enforcement mechanisms further enhance trust, property rights, bankruptcy processes, and contractual enforcement mechanisms are comparatively transparent. Confidence in institutional reliability increases demand for dollar assets during periods of global uncertainty. The dollar therefore benefits from crisis dynamics. During the financial instability, capital flows towards perceived safe havens, trade invoices, and commodity prices. The dollar as the language of commerce. A significant proportion of global trade is denominated in dollars, even when transactions do not involve the United States. Oil, natural gas, metals, agricultural commodities, shipping contracts are frequently priced in dollars. This phenomenon is sometimes referred to as the petrodollar system. Energy markets reinforce dollar demand because energy is a universal production input. Countries require energy imports regardless of domestic economic conditions. Pricing commodities in dollars standardizes contracts and reduces exchange rate risk for producers and consumers. Derivative markets for commodity hedging are also denominated in dollars, further reinforcing usage. Once commodity markets standardize on a currency, changing the invoice unit requires renegotiation of contracts, risk management models, and settlement systems. Stability encourages continuity. Dollarization and sovereign dependence. Some countries adopt the US dollar as their official currency. This process, known as dollarization, eliminates exchange rate volatility and increases monetary credibility. Dollarization sacrifices monetary sovereignty in exchange for stability. Countries with histories of hyperinflation or fiscal instability may prefer the discipline imposed by adopting an external currency. Dollarization reflects institutional asymmetry. Trust in US monetary stability works. Trust in US monetary stability exists. Trust in domestic policy frameworks. However, dollarization limits domestic policy flexibility. Governments cannot independently adjust interest rates or exchange rates in response to economic shocks. Stability is often at the cost of autonomy. Financial globalization, debt markets, and capital flows. International borrowing is frequently conducted in dollars. Sovereign governments and corporations issue dollar denominated bonds in access to deeper capital pools and lower interest rates. Dollar denominated debt reduces currency mismatch concerns for investors. However, borrowing assumes exchange rate risks. If local currencies depreciate relative to the dollar, debt servicing cost increases. Emerging markets therefore become sensitive to Federal Reserve policy changes. When US interest rates rise, capital flows often reverse. Higher yields attract capital back to US markets. Emerging market currencies weaken. Debt burden increases. Dollar dominance transmits US monetary policy globally. Geopolitical leverage, financial sanctions as strategic instruments. Dollar dominance creates geopolitical leverage. International transactions often clear through US regulated financial instruments. This gives US authorities jurisdiction reach. Sanctions can resist access to dollar settlement networks. Financial exclusion can impose several economic constraints. Sanctions can target governments, corporations, financial instruments, and individuals. Access to the dollar system becomes conditional. Financial power becomes geopolitical power. States dependent on dollar liquidity must consider US policy preferences. The dollar therefore becomes function as instrument of influence beyond traditional diplomacy. The exorbitant privilege, structural benefits for the United States. Reserve currency status provides economic advantages. Demand for dollar assets lowers US borrowing costs. Government debt can be issued at relatively lower yields compared to other sovereign borrowers. Lower yields reduce fiscal pressure. Foreign investors allocate capital to US markets, increasing asset prices and reducing financial costs for corporations. US households benefit from lower import prices due to heavily strong currency. The US dollar can finance trade deficits by issuing liabilities denominated in its own currencies. This reduces external constraint risks. Most countries must earn their foreign currency through exports. The United States can create dollar denominated liabilities. Global demand absorbs supply. Liquidity demand stabilizes the system. Structural costs, trade imbalances, and industrial pressure. Dollar strength creates distributional effects. A strong currency reduces export competitiveness. Domestic manufacturing sectors face import competition. Trade deficit becomes persistent. Economic activity shifts towards services and finance. Industrial employment declines in trade sensitive sectors. Reserve currency status can therefore contribute to structural economic transformation. Fiscal sectors expand, manufacturing sectors contract, and economic structure changes. Benefits are unevenly distributed. Fiscal expansion incentives and debt accumulation. Lower borrowing costs reduce political incentives for fiscal discipline. Government can finance deficit at relatively favorable interest rates. Debt accumulation becomes politically manageable. However, long-term fiscal sustainability becomes uncertain. Debt levels increase faster than economic output. Interest rate consume fiscal resources. Future policy flexibility decreases. Reserve currency privilege may encourage delayed structural reform. Short-term stability may generate long-term vulnerability. Signs of erosion, gradual diversification of global reserves. The dollar's share of global reserve has declined from approximately 71% in 1999 to approximately 58% in recent years. Diversification reflects risk management strategies. Central banks increasingly allocate reserves to alternative currencies and gold. Technological innovation has increased liquidity in smaller currency markets. Digital trading platforms reduce transaction costs. Currency diversification reduces exposure to single country policy risk. Gold holdings have increased among central banks. Gold provides independence from national legal systems. Gold cannot be sanctioned. Reverse diversification reflects strategic hedging. The role of gold, neutral asset in fragmenting a system. Gold functions as a non-sovereign reserve asset. It is not issued by any government. It doesn't depend on institutional credibility. Gold provides protection against currency debasement risk. Gold demand increases during geopolitical instability. Central banks accumulate gold as a hedge against monetary fragmentation. Gold doesn't replace currencies. Gold complements currency reserves. Gold reduces reliance on a single financial system. Central bank digital currencies and technological disruption. Central bank digital currencies introduce potential structural change. Digital settlement systems could reduce dependence on correspondent banking networks. Cross-border transaction could become faster and cheaper. However, technological capability doesn't guarantee adoption. Trust remains essential. Institutional credibility cannot be digitalized. CBDCs may increase efficiency but do not automatically create global confidence. Financial architecture depends on governance quality. Technology cannot substitute institutional legitimacy. The euro and the yuan. Partial competition without full substitution capability. The euro represents a large economic bloc but lacks unified fiscal authority. Fragmented fiscal policy creates uncertainty. Sovereign debt markets are segmented. Political coordination challenge persists. The Chinese yuan is supported by economic scale but constrained by capital controls. Limited convertibility reduces global adoption. Investors require unrestricted capital mobility. Financial openness introduces domestic policy vulnerability. China prioritizes stability over convertibility. Policy trade-off limits reserve currency expansion. No competitor currently replicates the full ecosystem of supporting the dollar. Crisis behavior, safe haven dynamics. Financial crises reinforce dollar dominance. Investors seek liquidity and perceive stability. Capital flows towards US Treasury securities. Demand for safe haven assets increases. Market participants prioritize liquidity over yield. Crisis periods strengthen incumbent advantages. Network centrality becomes more valuable during instability. Uncertainty reinforces path dependence. Dominance becomes self-reinforcing. Multipolar currency system, probable structural evaluation. Future global monetary architecture may become multipolar. Multiple currencies may share reserve currency status. Diversification may reduce systematic concentration risks. Fragmentation may reduce single country leverage. Transition is likely gradual. Institutional transformation requires decades. Financial systems evolve slowly. Path dependence, constraint, rapid change. The dollar may remain dominant but less exclusive. Relative influence may decline without absolute collapse. Strategic implications, currency as an instrument of structural power. Reserve currency status represents structural leverage embedded in global economic architecture. Power derives from network centrality, institutional credibility, and liquidity depth. Currency dominance reflects trust accumulation over time. Trust is difficult to replicate. Alternatives must watch institutional reliability, legal transparency, financial depth, and geopolitical stability. Displacement requires systematic transformation. Incremental innovation is insufficient. The global economy operates through infrastructures that resist rapid change. Dollar dominance persists because the cost of coordination around alternatives remain high. Structural inertia protects incumbency. Conclusion: persistence with gradual transformation. The US dollar remains the central pillar of global finance. Its dominance reflects institutional credibility, financial depth, geopolitical influence, and network effects. Although diversification trends indicate gradual adjustment. Structural displacement remains unlikely in the near term. The future international monetary system may become more distributed, but structural transition will likely occur slowly. Currency dominance is not determined solely by economic size, it is determined by trust, liquidity, and institutional continuity. The dollar remains dominant because the system built around it continues to function efficiently relative to alternatives. The dominance persists until coordination shifts. Coordination shifts particularly slowly.